Let's be honest, it feels like the floor has just completely fallen out from under us, right? The headlines are screaming, your portfolio is probably bleeding, and every single instinct in your body is telling you to just get out, run for the hills. That feeling? That's market panic. But what if the hard data is telling a completely different story? Today, we're going to tear apart a deep quantitative report to see what the numbers are saying when emotions are running this high. So, on one hand, the panic seems totally justified. I mean, a staggering $6.18 billion has flowed out of Bitcoin ETFs. Institutions are clearly hitting the sell button. But if you look closer at the on-chain data, the largest wallets, the whales, they've quietly bought a net 70,000 Bitcoin during this exact same period of panic. So who's right? The fleeing crowd or the silent giants? Let's break down the evidence.
To really get what's happening, we need to treat this like a battle of two competing stories. So first, let's hear the case from the bears, what this report calls the Red Army. And their argument is powerful, mostly because it taps directly into the fear that pretty much everyone is feeling right now.
And the evidence? It looks overwhelming. Bitcoin is down over 25% in just a month, shattering key moving averages. The ETFs are bleeding out, with almost 700 million in outflows in just 2 weeks. The charts? They look terrible. If we lose that 65K support level, the next stop is probably way down below 60K. And here's the nail in the coffin. The price is now below the mining cost, which could literally force miners to sell just to keep the lights on. From this point of view, the case for more pain seems pretty open and shut.
Okay, but now let's just calmly consider the counter-evidence from the Blue Army, the quantitative case. While everyone's panicking, Michael Saylor's company just bought another $168 million worth. While ETFs are selling, that on-chain data confirms whales have soaked up 70,000 of those Bitcoin. And while the market is pricing in total disaster, the report points to a signed executive order for U.S. Strategic Bitcoin Reserve. And finally, that extreme fear. Historically, a fear and greed index this low has been an incredibly powerful long-term buy signal. So this brings us to the most critical point of conflict in the entire market right now. You've got this massive divergence between what the ETF flows are telling us and what the biggest wallets on the blockchain are actually doing. This quote from the report just reframes the entire narrative, doesn't it? The real question isn't just about selling pressure, it's about where those coins are going. See, this isn't just an exit, it's a transfer of ownership from what the report calls weaker hands to potentially much stronger, more convicted ones. 70,000. Let that number sink in for a second. That's nearly $5 billion worth of Bitcoin being moved into the hands of the largest, most convicted players in this market, all while the headlines are focused exclusively on the ETF outflows. It's kind of crazy. So to make sense of these two opposite realities, the report uses a framework called a Bayesian verdict. Now, it sounds complex, but the idea is actually pretty simple. It's just a logical way to weigh new evidence. Instead of getting locked into an emotional story, you constantly update what you believe based on the strength of new, hard data. So when we actually weigh the ETF outflows against the whale buying, the verdict isn't a clear win for either side. Not yet, anyway. It's more like a high-stakes standoff. The whales are absorbing a huge amount of the selling, but they haven't completely crushed it. That's why the report calls this an observation period. The key signal we're all waiting for now is a reversal. That moment when weekly ETF flows finally turn positive again. All right, so how does the report take all this conflicting information and make sense of it? Well, it distills everything, the fear, the whale buying, the policy news, down into a single proprietary score. And the final verdict from this Shiran index is a 65 out of 100. Now let that sink in. In a market where the popular fear and greed index is at a terrifying 8, signaling absolute extreme panic, this quantitative model is spitting out a strongly bullish 65. This right here is the very definition of a bullish divergence. And this score isn't just based on price, not at all. It's a holistic view. As you can see in the breakdown, it's pulling in fundamentals like whale buying, legal and policy stuff like that reserve order, and even insider activity. So what you get is a much more robust picture than just looking at price charts alone. And if we dig a little deeper, we see the strongest drivers of the score are insider conviction, which is way up at 78, and the quant signals. Now this is the key insight. The model interprets extreme fear and a deep price crash not as a reason to sell, but as a classic historical buying opportunity. In other words, the weakness in price is actually strengthening the quantitative bull case. And that right there is the central thesis of this entire report, a bullish divergence. The fundamental on-chain data is actually showing increasing strength because the price and the emotional data look so unbelievably weak. The two things are moving in completely opposite directions.
Okay, so let's bring all this evidence together and get to the report's final actionable conclusion. What does all of this actually mean for the price, right here, right now?
The system resolves these key debates really decisively. That argument about mining costs, the Blue Army wins. The model shows the cost basis has actually dropped, and the current price is right near this new, strong support level. What about the argument over technical support? Well, the Blue Army wins again. The report grades on-chain data as S grade. That's superior. And it's showing massive support at 65K. This basically overrides the weaker B-grade chart analysis that's pointing lower. So after weighing all of the evidence, the Bayesian model identifies a key zone. Now, this isn't some wild price prediction. It's a high-probability area of support, what the report calls an institutional defense line right between $66,000 and $68,000. The system doesn't just stop at analysis, though. It gives you a specific rules-based plan. It has already triggered an initial buy signal based on a triple threat. You've got extreme fear, a deep price drawdown, and strong whale accumulation all at once. The plan, then, is to reinforce that position once ETF flows turn positive, and finally, complete the full position once that key 65K support level is confirmed. Which leaves us with the ultimate question that this entire market really comes down to right now. Your gut and the headlines are screaming one thing, but the deep data, it seems to be whispering something else entirely. So when emotion and data are in a direct head-to-head conflict, who do you choose to believe? To make your own informed choice, you really have to go beyond the headlines. We've only just scratched the surface today. You can download the full 6-page deep verdict report we've been walking through by visiting the link on the screen. It's the tool you need to cut through all the noise and form your own data-driven conclusion.